Welcome to Electrified. It's your host, Dylan Loomis. Quick episode today, but important nonetheless. In case you didn't know, you can download ARK's entire Monte Carlo simulation document and edit certain inputs to play around with the model if you're into that. As I explain some things, I'm going to let you guys browse some pages of interest. So let's see how talented you are in multitasking. First, you guys know that I have the utmost respect and admiration for ARK Invest, the work they do, and the research they publish transparently. I think it's incredible, and I can't say enough good things about their team. I mean, look at this. They are uploading their granular Excel documents for us to see and edit. This is not common practice. That said, these new price targets are just that, their best guess. So yes, they were right before, and yes, this is the best one that I've seen from anyone releasing price targets for Tesla. But hear me on this. If you need someone else to tell you that Tesla will be higher in 2025, whether it's 3x, 6x, or 10x, you should spend more time researching the company and not waiting for someone to give you an arbitrary stock price estimate. Don't take this as me discounting the work or the accuracy of the projections or putting anyone down. All I am saying is, in my opinion, investors in general put way too much emphasis on price targets, especially the ones from ARK and especially new investors. Second, in the long run, it will be far more valuable to every one of us to read the research and do our best to understand the assumptions ARK is using to reach these price targets rather than just fixating on the price targets themselves. Spending time on understanding the fundamentals of the company and the Tesla differentiation will serve us much better. Sadly, most people don't want to do the work, and it is the path less traveled. Most people just want to be told where to put their money and how high it's going to go and by when. It's a real problem for a big percentage of the next generation of investors, and I do not want to be a part of feeding this narrative. Third, I would be happy to dive into this report and break some things down for you, and I still might, but I'm sure Rob at Tesla Daily will dive into this early next week. You guys know I do what I can to add value in ways other Tesla channels do not, and I am very cognizant of just becoming an echo chamber or reading information you can find in one place yourself. So if Rob doesn't cover the research like I think he will and get into the granular detail, maybe I will chime in later this week if you're interested in that. But for now, I just want to help all of us understand the main pushback this research is getting and why. No matter what, I would encourage you to read the research report linked below. It's really only a 10 to 20 minute read, excluding, of course, these Excel documents. So the pushback primarily stems from ARK using Monte Carlo simulations. So what exactly is that? A Monte Carlo simulation is just a model that shows the probability of different outcomes that cannot be easily predicted due to random variables. It's really just a way to effectively build this randomness into a model to help us understand the impact of risk and uncertainty in forecasting models. These Monte Carlo simulations are used in almost any field you can think of: finance, engineering, the sciences, supply chain, and many more. And yes, Monte Carlo is an actual place in Monaco where the Monte Carlo Casino is located. The very casino, by the way, where a few of the James Bond movies were filmed, as well as Ocean's 12 and Madagascar. But the Monte Carlo method was named after this casino by a physicist named Nicholas Metropolis due to the inclusion of random events associated with gambling and the simulations. And Monaco is not officially a part of France. It's actually an independent and sovereign country itself, located on the northern coast of the Mediterranean Sea. Here are the main problems with the Monte Carlo simulations. For what it's worth, I do think it's a great tool and can be very valuable, and from looking at ARK's, I think they've modeled theirs well. But in general, these simulations are just not perfect. Now, I'm most familiar with Monte Carlo simulations from my financial advisor days, where many in the field use them to project clients' retirement portfolio trajectories and returns based on certain spending and saving patterns. So, Monte Carlo simulations can do a great job of simulating the average annual returns of a portfolio over time, but they can't account for human behavior of pulling money out of portfolios in a down market due to fear. And the main alternative to the Monte Carlo method is a deterministic modeling approach where there is no randomness in the future outcome. It would be like assuming an average 10% return every year with no variability over time. Most of the Tesla models you see online are deterministic. This is when people predict a set number of cars sold each year, 1 million in 2021, 1.5 in 2022, and so on, not accounting for variabilities. I think it's clear to see why Monte Carlo tools in the field of stochastic models has grown. Computing power capabilities have skyrocketed. We know the world is very unpredictable, and with the surge of technology companies that you really can't value based on fundamentals without pooling revenue and profits from years into the future back to today, needing models to account for this future variability and randomness is crucial. And one more thing I feel strongly about, Monte Carlo simulations are really only constrained by the user inputs or the model that is being built. The only limitation really is the ability to build a model to account for as many variables as possible and to run that simulation hundreds of thousands of times. So here's an example. Let's say we want to determine the average height of the global population. Unless you want to go around measuring 7 billion people one by one and then taking an average, you'll want to use a Monte Carlo simulation. In theory, it's actually quite simple. You just measure the heights of a smaller sample size of the population and do your best to ensure the sample group is representative of the global population. We would do this by randomly selecting people all around the globe, not just in one area, as one location may have a community of really tall people. The second important part is to get the law of large numbers on our side. The more people we can include in our sample, the more accurate the average measurement will be. More people would give us higher confidence in our results. ARK has said they ran their simulation 40,000 times, which I would say generally speaking is average. The more samples we have, the fluctuations in the data become smaller and smaller. Think like full self-driving. The more data the system has, the interventions become more infrequent. So simply put, Monte Carlo simulations are randomly evolving simulations. They allow us to explore a random subset of possibilities. The more samples and data, the better the accuracy. One other drawback with these simulations has to do with the sequence of returns. So let's say we invest $100,000 in the S&P 500 in 1996. These are the annual returns we'd be looking at over 10 years. At the end of 10 years, our money grows to $238,673 or about 9% a year. If these returns were to happen in the opposite order, we make the exact same amount, $238,673. The order of returns only matters if you're either investing regularly, like by dollar cost averaging, or withdrawing funds regularly, like taking distributions. If a high portion of negative returns happens in the beginning years of retirement when you are taking distributions, let's say $60,000 a year, you would end up with $125,691 still invested and the $60K in cash for $185,691 total. Now compare this to the first sequence where the first few years of returns are strong. With your distribution staying the same, you would end up with $222,548 total, $60,000 of which is still in cash. This is what we call sequence risk, something Monte Carlo can't quite account for. And when it comes to modeling for Tesla, this can apply to almost any business decision. ARK didn't include Bitcoin or utility energy storage or the solar business in their model, but had they, Tesla's decisions to buy and sell Bitcoin and the timing of those events can't be accounted for. The decisions to ramp up CapEx spending versus toning it down if demand were to slow, we can't really predict human behavior nor the timing of it. So here's what I think you need to know. I'm only sharing these drawbacks to help balance out the sentiment in the space. I don't want to see people selling their homes or increasing their margin limits to buy more Tesla just because ARK said it will be higher in a few years. Doing something like this may sound crazy to some of you, but when you get into the depths of the internet for research, you read some pretty wild stuff, and this type of thing is actually happening. But I do think this specific research is very valuable and by far the most reasonable price targets we have. Price targets for Tesla 1 year out, like the rest of Wall Street does, really make no sense to me, and it feels pointless, whereas a 5-year price target definitely has more variability, but it helps us to see the bigger picture a bit more, which I really like and find more valuable as a long-term investor. I am also a believer in Monte Carlo simulations and that they can be incredibly effective tools when implemented properly and understood in their proper context, drawbacks, limitations, and all. And I will also say, because I know some of you want to hear it, even without this report, I would be confident about Tesla stock price cruising past 3K by 2025. Remember, this report doesn't include Bitcoin, utility energy storage, or solar. But look, ultimately, let's not complicate things by trying to pin down a specific number. The only question you need to ask, is Tesla a good long-term investment? The answer is still a resounding yes, in my opinion. So please take a second to like this video if you appreciate me trying to bring fresh perspectives to the Tesla space. I know it's not always the popular choice, but I genuinely care about being valuable to all of you. Until next time.